Since 1972, the McIlvaney Financial Group has been a conservative, contrarian investment firm. With that mindset, they have created a multifaceted approach to portfolio management, offering a wide array of services including hedging through precious metals, wealth advising, a unique short fund, and an excellent educational resources. We have had David McIlvaney on our show multiple times because we respect his outlook, viewpoints, and recommendations. You really need to take advantage of the free portfolio risk analysis and bank safety ratings they're offering our listeners. Just call them at 1-800-525-9556, and you will be put in touch with an advisor with years of experience who can take 15 minutes and give you a much better understanding of what true portfolio diversification is. Again, call them at 1-800-525-9556 and benefit from their expertise. Hi everyone, this is Jason Barrick of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I'm really excited to have him back on. He worked in the financial industry for over 20 years in many different jobs, and he's the best-selling author of a number of great books. All of his books are Currency Wars, The Death of Money, The New Case for Gold, and his newest book is The Road to Ruin, which I just mentioned I finished and I enjoyed it a lot. Jim Rickards, thank you for joining me again.
Thank you, Jason. Great to be back with you.
Now, Jim, before we talk about some of your books and how that relates to what's going on today, I want to talk about your recent visit to China. Is physical gold demand still strong there?
It is strong. And while I was there, I was in Shanghai and Nanjing a couple months ago. And my reason for being in Shanghai was I was speaking to a very interesting group. It's called the China Chief Economist Forum, so CCEF. Basically, these are the chief economists of all the major commercial and investment banks in China, including Chinese branches of U.S. firms. So there were, our friends were there from J.P. Morgan and Merrill Lynch and others, but mostly the Chinese banks themselves. Great group of not only speakers, but also policymakers, government officials, and a very high caliber audience. So it's always fun to speak to an audience like that. But in the course of that, you have a lot of side meetings, and I was able to sit down at breakfast with just four of us at the table, five at the table, three of whom were the top precious metals dealers for two of the five biggest Chinese banks. So basically the people who knew more about handling physical gold than almost anyone in China. And they just said to me, don't believe what you hear about Chinese demand drying up. They said it's extremely strong. We're moving as much gold as we can. So that was consistent with what I had heard elsewhere, but it's always interesting, to get it straight from the horse's mouth, so to speak, and in this case, straight from the people who are dealing the gold. But I also learned something which I didn't know, which I'd been puzzling over for some time, which was, it's very clear that the Chinese government is non-transparent on the subject of gold. They have recently, meaning in the past couple of years, for the first time in 5 years, begun reporting their gold holdings with more frequency. This is really in response to IMF requirements. The IMF, International Monetary Fund, said, if you want us to include include the Chinese yuan in our world money, the IMF special drawing right, or SDR, you, China, need to bring up your game in terms of reporting and transparency and so forth. So China has done that, but only halfway. They still have a lot of gold off the books, so to speak, not reported as part of the official reserve holdings of the People's Bank of China. So looking at other data, such as mining output from geological surveys, Hong Kong exports to China, shipments from Switzerland to China, et cetera, it's possible to estimate that China has perhaps 3,000 or 4,000 tons of gold, maybe more, relative to the approximately 1,800 tons that they officially produce, that they officially acknowledge. So they probably have more than twice as much gold as they admit. But what I wasn't sure of, and looking at the Shanghai Gold Exchange, and those numbers, as far as we know, are fairly accurate. You can also look at physical output of gold in China, physical sales of gold. It wasn't clear to me how much was government demand and how much was private demand, because that would be one way to estimate government holdings. And what they told me is that is 100% private demand, meaning that whatever the government's doing, they're doing it through separate channels. They're not doing it through the Shanghai Gold Exchange. They're doing it through agents for undisclosed principles, covert means, using military and intelligence assets. I know some of their dealers, that is the government dealers, not the private dealers, are at HSBC and ANZ and some of the other banks. So what it told me was that there's even more demand for gold than I estimated, because I was assuming that maybe 50% of the Shanghai Gold Exchange was going to the government and the other 50% going to private hands. But they told me 100% was going to private hands. And given the information we have on government holdings, that means there's a lot more gold in China than we thought. So that, again, reinforces and bolsters the story that China is preparing for a post-dollar world. Not necessarily the end of the dollar, but perhaps the end of the dollar as the benchmark global reserve currency.
Yeah, and we know that the Shanghai Gold Exchange had record withdrawals in November 2016 and February 2017, and yet the numbers that the World Gold Council and GMFS were releasing didn't jive with that. So I wanted your input since you had actually visited there. I know you've actually been to Swiss gold refiners too. Are you still hearing that these Swiss gold refiners are running 24/7, 365 and having trouble sourcing large orders of physical gold to recast to 999 kilo bars to send back to China?
Yes, I'm in regular contact with parties there now. I've been to Switzerland a number of times. I've actually visited the refineries and visited the vaults, seen physical gold. Open a case and there's $25-30 million worth of gold bars inside. So I've touched it and worked with it among people who actually handle physical gold, as I say, the secure logistics providers and the refineries in Switzerland. But having said that, sure, through my contacts, I'm in regular touch with them, and I haven't heard any change in the status, which is they're refining gold as fast as they can. They've expanded capacity to handle more orders. They have a backlog of orders they can't fill. And there's more demand from China than they can fill. They ship a lot to China, but China would like more but can't get it. That's because they have other customers, older customers, in the jewelry industry and elsewhere who they have to provide gold for as well. But they're having trouble sourcing it. A refiner takes in gold from three sources. One are miners, so they get what's called doré, which is a miner will produce gold bars that are about 80% pure. The technical name for that is doré. They then ship that to the refiner. The refiner will make it 99.99% pure. That's where the 4 nines comes from. So that process of taking it from 80% upwards to close to 100% is what the refiners do. So that's one source. The other source are existing gold bars, mostly from London, the old 400-ounce so-called good delivery bars. That's a standard set by the London Bullion Market Association. With our, it can vary a little bit. That's the people say a 400-ounce bar. It can be, there's a range kind of from 395 to 405, maybe a little wider than that, but it's close to 400 ounces with a little bit of wiggle room. But a lot of those bars are 2 nines and 3 nines, meaning 99% pure or 99.9% pure, but not 4 nines. So those bars come in from London, from existing vaults, from ETF disgorgement, and elsewhere, and then those are refined into these 491 kilo bars that China wants. And the third source is what's called scrap. Scrap's not a very glamorous term perhaps, but it's basically jewelry, watches, rings, earrings from that have been sold to dealers. You see these little signs in strip malls around the country, "We buy gold." By the way, people disparage that. They make fun of that as if gold is somehow not an important monetary asset. They say, "Look at all those signs," and I say, "Well, yeah, look at what they say. They say we buy gold. They don't say we sell gold." In other words, there's some of them do maybe, but the point is there's a network of demand out there. But those dealers, those little strip mall dealers, they will buy, kind of like a pawn shop. They'll buy, rings, jewelries, bracelets, earrings, and so forth that people no longer want or need, and they just bundle them up and weigh them and send them to the refiners through middlemen, and that comes in as scrap, and that can be 14 karat, it can be 18 karat. And maybe there's other alloy in there, and then that gets refined also. So you have three sources: doré, existing gold bars, and scrap. And there's difficulty in all of them. I mean, mining output has not been expanding. It's been kind of constant, but not really growing significantly. One of the interesting anecdotes about the existing bars, these, if you've ever seen a gold bar, a 400-ounce good delivery bar, it's got a bunch of stamps on it, impressions really, that, there's one from the refiner, there's one from the assayer, that's a different company. There's one with the weight, as I said, it could be 397 ounces, doesn't have to be 400. One with the purity, again, could be 3 nines, not 4 nines. And also the year, then there's individual serial number and the year it was cast. So it's kind of like a dollar bill. You look at it, it's got dates and numbers and denominations, et cetera, on it. Gold bars very much the same way. Well, when you store these bars, it's kind of on a LIFO basis, last in, first out, meaning you have an empty vault, you start putting gold in, you stack it up, and then obviously the most recent stuff is closest to the door. And so one of the refiners told me, he said, we're starting to see bars from the 1980s, not new bars, but pretty old bars. He said, it tells me that they're scraping the bottom of the barrel in these vaults, that whatever bars we're getting, that those vaults are close to empty because they would have had to go back, to the back of the vault to get these old bars. And so put all these things together, what I'm hearing about the demand side in China, what I'm hearing about the supply side in Switzerland, it tells me that the physical, it's not an outright shortage at this point, but gold is definitely scarce in the trade. And of course, we know that the paper gold market is massively leveraged on the amount of physical gold available. When I say the paper gold market, we're talking about COMEX gold futures, unallocated gold forwards from London Bullion Market Association banks, ETFs, and other forms of paper transactions. In theory, backed up by gold, except there's only a small sliver of physical gold to support all those contracts. If those contract holders in a financial panic or in a period of great uncertainty turn to these exchanges and banks and dealers and said, you know what, give me the gold. I want my physical gold, and I want to convert my contract into delivery. There's not anywhere near enough gold to supply that, and less all the time. And so what would happen, of course, is that they would terminate the agreement. So they wouldn't steal your money, but they would send you a notice that your contract was terminated early, and you would get yesterday's price, price at the close of business yesterday. And you're sitting there saying, wait a second, I don't want yesterday's price. I want today's price or tomorrow's price or the day after. The gold is skyrocketing. That's why I bought the contract as a form of insurance. Now you're telling me my fire insurance is canceled the minute the house catches on fire. And that's about what would happen. So, so I do expect that kind of, in a panic, certainly that would happen. But maybe even before then, we'll see a failure to deliver even a modest amount of demand for physical gold from paper gold holders. These banks have to go out now and source it. If you have an unallocated gold forward contract with, JP Morgan, let's say, and you decide to convert to physical, let's say it's not a panic. You just want your gold for whatever reason, personally. They're taking, I've heard stories where they're taking, 4 or 5 weeks to come up with the gold. That tells, we know it's not in the vault. There's only, like I say, a small fraction of the vault. But what they do is they have to go out and get it from another dealer, from another source, and then deliver it to you under the contract. Well, that, by law, that can't take more than 28 days, or else it's an illegal gold futures contract that has to be exchange traded. But in some cases it is. People are turning a blind eye to that. But this is definitely something that's going to blow up in very adverse ways to the gold dealers and the paper gold contract counterparties. It's one reason I recommend physical gold for your allocation.
Yeah, and the primary gold and silver miners are struggling too because the price hasn't risen. They've cut their costs to the bone during the bear market since 2011. The Indian refiners, I've heard, Jim, are having trouble sourcing physical gold too. They're willing to pay premium sometime for scrap in India in order to get the supply they need for their refinery. I want to ask you now, since you were in China too, how worried are the Chinese about a large trade war with President Trump potentially putting large tariffs on importing Chinese goods? And we know from your original book, Currency Wars, that can also, trade wars and currency wars kind of are tied hand in hand.
They're extremely worried. Now, I was in China between the election and the inauguration. So Trump was the president-elect. He was going to be the president, but wasn't sworn in yet. So all people really knew was his campaign promises. They hadn't seen, all the appointments and the actual policies. Of course, here we are several months later, so we have a little more of a sense of what Trump's actually going to do, although I would say a little more, but not a lot more necessarily, because Trump seems very mercurial and prone to change his mind, whether that's the art of the deal or not. You can debate, but the fact is he has had a number of reversals of prior positions, so hard to know what to expect. But when I was there, every single person I talked to was deeply concerned and asked me. I was the token American. There were a few other Americans there, but not that many, and mostly, obviously, the Chinese, and then some Japanese and Europeans and others. But I was one of the few Americans, so I got sort of singled out for questions. They were all extremely nervous and extremely concerned. And I didn't. I have to say, I didn't. Just speak to the elites. I went out and took a couple long walks on what's called the Bund, which is the riverfront promenade in Shanghai. Great walk and stretch your legs a little bit, but also fantastic architecture. A lot of it from the kind of Art Deco period buildings from the 1920s and 1930s, some earlier, when before the communist takeover, and a lot of them have been beautifully restored. And if you're an architecture buff, it's one of the great strolls in the world. But you go down the Bund, and there are a lot of younger people in particular, and people studying English who don't have the opportunity to get out of China. They're learning English in a Chinese classroom, and they see you're an American, or they guess you are, and they just kind of walk up. They're very friendly and walk up to you and strike up a conversation, because they literally want to practice their English. So it was fun for me, because it gave me the opportunity to talk to students and everyday people, and then you also talk to whether it's hotel clerks, taxi drivers, store clerks. I do make a point when I travel to speak to as many everyday citizens of the countries as I can, rather than just the elites. And I heard this concern everywhere. So from the top economists and government officials down to, 24-year-old students on the Bund, they were all concerned. But the other thing I heard was capital flight. Everybody's trying to get their money out of China, by hook or by crook. Some people have a greater capacity than others, because they're running, if you're running a multinational business, you can use what's called transfer pricing, where your foreign subsidiary overbills the Chinese company for shipments, and so money ends up being transferred offshore to pay inflated bills. They launder money through casinos. Some people are using Bitcoin. Some people are, flying to Hong Kong and buying gold and using a credit card. Like I say, some legal, some illegal, but everybody's trying to get their money out of China.
Yeah, and you've talked about that in The Road to Ruin, with governments setting up global capital controls. We have Thomas Piketty talking about governments enforcing a global wealth tax, which is like a cooperation global capital control. I interviewed Paul Craig Roberts, Jim, in January, and he said the U.S. isn't allowed to, according to WTO rules, they're not allowed to put, say, a 20% or a higher tariff on Chinese goods or Mexican goods. How do you think they would potentially get around that then in order to implement something like that?
Just do it anyway. I mean, I don't want to dispute Paul Craig Roberts on the point of law, but from what I've seen from the Trump administration, first of all, a lot of these laws have loopholes. The biggest loophole I'm aware of in the WTO structure is national security. So all that would have to happen is the president could issue an executive order under the International Emergency Economic Powers Act of 1977 saying that there was some kind of national emergency, and I think that would be enough to blow a hole through WTO. But even if you didn't go to that extreme, just do it anyway. And then what's the answer? Well, they got to sue you. Well, then they got to go to court, and you have hearings, and it takes 2 years. Well, 2 years is a long time to be suffering with a tariff, and maybe it's a forcing strategy to get some concessions, and then you make the concessions and they drop the case. So again, I don't dispute Paul Craig Roberts on his point, but I do think there are multiple ways around it.
Yeah, and China could also do a currency devaluation to counter that. So we could, the trade wars could create additional currency wars. China could change the exchange rate on their dollar peg. I want to ask you now about this global U.S. dollar shortage. I hear a lot of hedge fund managers talk about this on Real Vision TV. The Bank of International Settlement says there's $10 trillion approximately in U.S. dollar debt. outstanding globally from foreign governments, foreign corporations. But from what it seems to me, Jim, it seems that why are these guys? Why, if there is a shortage, why did all these guys borrow in dollars then?
Well, let me just unpack that a little bit. I think the 10 trillion figure from the BIS, if I'm not mistaken, that refers to emerging markets corporate dollar-denominated debt. And the reason I'm kind of parsing those words a little bit is precisely because it's not sovereign debt. I mean, sovereign debt is much greater, a much larger number, but the developed economy debt and bank debt is a much larger number. So we're talking about upwards of $10 trillion of emerging markets dollar-denominated corporate debt. That's a big deal because the IMF can't directly bail out corporations. They can bail out countries, and maybe a central bank that gets an injection of dollars from the IMF can use some of that to help their corporations, although the IMF might place some conditionality on that bailout money and say you can't do that. So it's not clear that you can actually bail out these corporations if you're suffering a dollar shortage in your reserve accounts, and of course these companies are having borrowed in dollars. A lot of their revenues come in local currency. Imagine a Turkish textile manufacturer. They're borrowing dollars to finance a plant, and maybe they export some abroad for hard currency. But if some of their output is domestic, then they're getting paid in local currency. So you have a currency mismatch. Now, why do people put themselves in this position? Well, it's pretty obvious. It's because of Bernanke's zero interest rate policy. If we saw this, in places like Hungary, where the Austrian banks were in there offering Swiss franc mortgages to Hungarian borrowers. Hungary is not a member of the euro. They have a local currency, the florent. So you're a Hungarian couple trying to buy your first house, and florent interest rates are 9% and Swiss franc interest rates are 1%. Well, which mortgage are you going to take? Well, you take the 1% mortgage. But the assumption, of course, is that there'll be some kind of they'll maintain the exchange rate between the florent and the Swiss franc. Well, that broke, in the crisis in 2008, 2009. They broke the peg, and the florent deeply devalued against the Swiss franc, and it was as if your mortgage doubled. Imagine having a $200,000 mortgage, and you wake up one day and it's a $400,000 mortgage because your florent is worth less, and you need twice as many to pay back the Swiss francs. So that's the same thing happened in Thailand in 1997. You see it time and time again, and so the way these so-called carry trades get busted is, you borrow in the cheap currency and you invest in some higher yielding asset or currency, and you leverage it up a little bit, and it's all good until the currency devalues, and all of a sudden you turn around and, because when you borrow dollars, you're short dollars. You got to pay back dollars that you don't have. So you are short dollars, and if the dollar gets stronger, it's like any short in any market. If you're short and it goes up, you lose. And what's been happening, beginning really May 2013 with the taper tantrum, December 2013 with the beginning of the taper, November 2014 with the end of the taper, December 2015 with the liftoff in interest rates, and now 2 more interest rate hikes along the way, and more coming, I expect. We're in this tightening mode, and the dollar is very strong, and it's putting a lot of stress on people around the world who are short dollars. So there is a dollar shortage. Now, that's also surprising to people because they say, well, wait a second. The Fed printed $4 trillion to remedy the last crisis. How can there be a dollar shortage when they printed $4 trillion? Well, the answer is that the Fed did print $4 trillion, but the world created $100 trillion of debt. Again, the 10 trillion we talked about, that's just the emerging markets dollar-denominated corporate debt. But what about developed market debt, bank debt, corporate, sovereign debt, et cetera? Well, that number is 100 trillion. So 4 trillion of money printed by the Fed is not very much if $100 trillion worth of debt holders want their money back.
This dollar shortage, Jim, seems to me like the alcoholic who has all these booze at his house. He drinks them all and says, now there's an alcohol shortage. So that's what I view as this global dollar shortage. Well, why did you borrow so many dollars in the first place? No one forced you to. You used them. You can't pay them back. You're having problems. And now you're saying there's a shortage and you have your hand out and you're going to either another central bank or the IMF or someone else.
Well, yeah, I'm sure there's a moral, ethical dimension to all this, but that's not what I mainly focus on. I'm a little more analytical when it comes to that, and I just see this getting worse as the Fed goes down the tightening path, as the dollar gets stronger, as the economy slows down, as the companies use up their lifelines, and who's more bankrupt than the state-owned enterprises in China, but they're being kept alive by the government. By forced lending. The government's forcing the banks to lend to the state-owned enterprises. The government's forcing the state-owned enterprises to hire people they don't need, preventing shutdowns of redundant capacity, et cetera, all to have to avoid rising unemployment in China. But none of this makes economic sense. It's whether it's a classic kind of Austrian misallocation of resources, malinvestment, so-called, or just short-term thinking. Either way, it's non-sustainable, and of course the old cliche of something is non-sustainable, it won't be sustained. So as to the exact timing, that's a lot more difficult because you can keep these things going longer than most people expect, but they will all hit a wall probably sooner than later.
Yeah, and I think we're starting to see a lot of signs in the real economy that there's stagflation. There's been a lot of misallocation of capital. There's a lot of higher costs in the supply chain. People's food and rent is going up like crazy in the United States. I want to talk now about complexity theory. So the predictive models these Keynesians use for GDP and so many other things, they just have a horrible long-term track record. I mean, the Atlanta Fed revised their GDP down a month later by more than 80%. But why do Wall Street and the mainstream media and academia still cling to these Keynesian models that spit out things like GDP and jobs and other numbers and inflation rates? And why do they act like there's any credibility to these numbers then? And how does that have to do? I know you've studied complexity theory, so why is it better than the predictive Keynesian models?
Because it works. But just going back to the Keynesian models, by the way, I'm a big fan and admirer of John Maynard Keynes. I just don't like Keynesians. Keynesian economics, as we've come to understand it, has almost nothing to do with John Maynard Keynes. It was actually something kind of invented by Paul Samuelson and the faculty at MIT in 1947, and it's taken on a life of its own since. But I like to say if John Maynard Keynes were alive today, he'd be spinning in his grave at what people call Keynesian economics. But that said, you're right. These models are they're called dynamic stochastic general equilibrium models. They work off of some Keynesian concepts, but they have a lot of other concepts built in. They rely heavily on regressions and correlations, and they bear no relationship to reality. They're obsolete. And all you have to do is, to back that statement up, every year the Fed gives a one-year forward forecast. So in 2009, they have a forecast for growth, economic growth in 2010, they have a forecast in 2011, and so on every year. They have been wrong by orders of magnitude 8 years in a row. When I say orders of magnitude, I mean, if they said they forecast 3% growth and came in at 2.9, I would say nice going. Like, that's really close. You guys did a great job. It's not even close. I mean, they say 3% and it comes in at 1.5, or they say 2.5 and it comes in at 1.6, or these are huge errors. And when the whole range might be somewhere from kind of -3 to +4. I mean, it could technically go outside those boundaries, but -3 to +4 is a huge range for all the expected outcomes of annual GDP year over year, and yet they can't get within a full percentage point in a 7-point range. And so if you've been wrong 8 years in a row, why should I believe you for the 9th year? I mean, at some point you need a wake-up call, and you have to say, look, whatever they're doing doesn't work. I mean, many examples. This is not, when I say this stuff is obsolete and doesn't work, I'm not just name-calling. I mean, you can back it up. Look at the 2009 stimulus bill pushed by the Obama administration in response to the financial crisis and the recession that was, sponsored by Larry Summers, who was head of the National Economic Council at the time, Christina Romer, who was, I believe, chairperson of the Council of Economic Advisors, and others. And that was almost $900 billion of more deficit financing over and above the baseline budget that was supposed to stimulate the economy. And Romer estimated a Keynesian multiplier of about 1.5, and it wasn't even close. I mean, it came in less than 1 because, first of all, most of the money wasn't, remember, shovel ready, or all these shovel ready projects? Well, they weren't ready. And a lot of the money went to teachers' unions, municipal employees, other kind of favored interests of the Democratic Party, and relatively little of it went to infrastructure. And what did took years to actually get the money out the door. And here we are 8 years later, and we're still looking at the same. I mean, we just pretty much with the GDP revision for the fourth quarter 2016 that just came out, we now have full year 2016 growth of 1.6%. 1.6%. When historically the U.S. is capable, trend growth is more like 3.5. That's 1.6%, 8 years after the so-called stimulus. So anyway, I could go on with many other examples, but the stuff doesn't work. The reason it doesn't work is, well, there are a lot of reasons, but one of them is that it doesn't take into account recursive functions, reaction functions, what are called emergent properties in complex dynamic systems. To the extent it relies on statistical science, it assumes risk or outcomes or time series of prices are normally distributed, which they're not. Again, empirically, they're distributed in accordance with what's called a power curve. So just a long list of criticisms. Your other question, Jason, as well, if it's that bad, why do they cling to it? And the answer is there's this enormous academic and cognitive inertia in these things. If you imagine you spent 30 years of your life doing things one way, and then some critic comes along and says, that's all wrong. You're supposed to do it this way. You're not going to change it up. Imagine you're a 28-year-old PhD candidate at an elite economics or finance program, and you go to your professor, your potential thesis advisor, and you say, Professor, I'd like to write my thesis on complexity theory, which says that everything you've been doing your whole career is wrong. You're not going to get the big name thesis advisors. You're not going to get the faculty appointments. You're not going to get the fellowships. You're not going to get published. You're not going to get a job. Basically, you'll be frozen out of elite academic economics circles, and people know this, so they come along and say, well, I'll write the 958th variation on the Keynesian multiplier. So don't underestimate the extent to which some combination of denial, inertia, laziness, academic jealousy, etc., play a role in perpetuating these obsolete theories.
Yeah, Danielle DiMartino Booth wrote about this in her book Fed Up, because she worked in the Dallas Fed for 9 years, and she was talking about their culture of groupthink and hubris, despite the fact that, their models never had a proven track record of actually, predicting anything accurately in the real world, and how, they wouldn't even listen to anyone if they didn't have a PhD in economics. They wouldn't even listen to her, and she had worked on Wall Street for years, and Richard Fisher, who was like one of the few guys who dissented on the QE programs, they didn't like him because, number one, he dissented on Bernanke, number two, he didn't have a PhD in Keynesian economics.
Yeah, I've had experiences speaking to senior people in the monetary research department, say at the Federal Reserve Bank of New York, and other Federal Reserve officials. And when I have the discussion that we're having right now, I don't mind disagreement, and I don't like to debate claims. I like to debate methodology. So if I have one forecast in the market and you have a different forecast, that's kind of a sterile debate. I'd like to say, well, what's your method? What's your analysis? What's behind what you're saying? I'll tell you what's behind what I'm saying. And I think you can have a fair debate on the method. But when I have these conversations, there's no debate. I mean, they can't even process what I'm saying. It's not like, okay, Jim, I hear you, but let me tell you why I disagree. That's not how the conversation goes. It's more like, what are you talking about? And so they can't even process something that's outside their domain. And so I'm not optimistic that any of this will change before that kind of wall of ignorance leads us straight to another financial collapse.
Yeah, they're in an intellectual bubble, and people used to say this about Steve Jobs, that he had a reality distortion device. So it sounds like the people in the Federal Reserve have a similar device. I want to ask you in closing, Jim, about ICE 9 from Road to Ruin. We talked earlier in the interview about China. They have capital controls. India, with this demonetization scheme Modi does, the more affluent people in India are trying to get, I think, 200,000 or 250,000 per year they're allowed to pull out of the country. This is why there's a demand for physical gold and silver and Bitcoin. Do you see global capital controls increasing a lot before or during the next global financial crisis?
Well, they will absolutely increase in the crisis. Prior to the crisis, not necessarily, because except on a selective basis, because they won't see it coming. When I say they, I mean the global monetary elites. So although it's interesting, China just got in the SDR. The SDR is the special drawing right, which is a world money issued by the International Monetary Fund, the IMF. They were officially admitted, made part of the SDR September 30th, 2016. So just about 6 months ago. And part of what the IMF calls for among the kind of elite currencies that are in the SDR, there are only 5. It's the U.S. dollar, the euro, the Japanese yen, pound sterling, and now the Chinese yuan. So basically the 5 major currencies. Although I think you could make a better case for the Canadian dollar or the Australian dollar, or being included in the SDR. But be that as it may, the Chinese yuan is in. But the IMF insists on an open capital account. Well, China is shutting down their capital account as hard as they can, basically because they were going broke. They started in 2014 with about $4 trillion in reserves. Sounds like a lot of money, but the problem is once the run on the bank starts, it's never enough. The $4 trillion pretty quickly became $3 trillion, actually 2.9 not that long ago. So the trillion went out the door in basically capital flight, or paying off some of this dollar-denominated debt that we talked about earlier. And people say, well, that's fine. You still have $3 trillion to go. Well, not really, because of the remaining $3 trillion, approximately $1 trillion is illiquid. It's there, it's wealth, but it's not money you can use to defend the currency. It's invested in KKR. I mean, try getting your money back from Henry Kravis if you have a 7-year lockup. So again, the wealth is there, but it's not liquid. Another $1 trillion has to be kept as a precautionary reserve to bail out the banking system, because the banking system's insolvent. China has bailed it out before. People say, well, I'm not worried about the banking system because Beijing can bail it out. Well, that's true, but not for free. It's going to take $1 billion to bail it out. Or sorry, $1 trillion. I misspoke. $1 trillion to bail it out. So that's another $1 trillion. So you take the $4 trillion, take out 1.1 that's out the door, another $1 trillion for precautionary reserve to bail out banks, another $1 trillion that's illiquid. You only have about $900 billion left liquid to defend the currency. And until recently, they were draining it at $35–50 billion a month, which means you're going to be broke within a little over a year. Now, obviously, that's not going to happen. But the question is, how is China going to prevent it? And there are only a couple of different ways to do it. One is a maxi devaluation of the currency, which I still expect. You could raise interest rates, but that would bankrupt a lot of companies and create the unemployment situation they're trying to avoid. So let's take that off the table. And the only other choice is to close the capital account, which is what they've been doing. Now, that's non-sustainable because, it not only affects, it might be nice to cut down the capital outflows, but that's going to cause the inflows to dry up. Capital movement is a two-way street, and who's going to put money into China if you can't get it out? So they're going to kill their direct foreign investment into China, their inbound capital flows, by putting on these capital controls. This is one of the reasons for the rise in Bitcoin dollar prices, because people in China have been using Bitcoin to try to get their money out, although that's cooled off a little bit lately. So China's, they're between a rock and a hard place. There's actually a name for this. It's called the impossible trinity, based on the work of Mundell in the early 1960s. It says you cannot have an open capital account, an independent monetary policy, and a fixed exchange rate at the same time. It's impossible because of arbitrage and because people taking advantage of one of those avenues, and therefore that system will break. The only question is how will it break and when, and the answer is usually sooner than later. And it's usually either the capital account or the exchange rate. And for now, China's clamping down on the capital account, but I expect at the end of the day they'll fix this problem by devaluing the yuan, which is, another reason people are trying to buy gold.
There are so many economic landmines out there, Jim. China's just one of them. There's pension funds in the United States that are drastically underfunded in so many different states. Subprime auto loan market, with the oil price now, if the oil price were to either stay at these levels or go lower, there's a ton of high yield debt, that energy debt that could blow up as well. So there's just so many different economic landmines out there right now. So I think owning physical gold outside the system, and also cash, I think, cash for opportunities in case there is a market crash, and Janet Yellen does increase interest rates a couple more times in 2017 and does things. When I interviewed Danielle DiMartino Booth, she said that she thought that the Federal Reserve would probably raise interest rates 2 more times in 2017, and that it was going to be a political weapon so the Democrats could get back more seats in Congress in 2018 elections and to make Trump look bad for taking credit for the stock market rally.
That might be their intention, but it won't play out that way. I do expect they'll raise rates in June. They probably intend to raise them again in September, in December, if they can. But what I expect is the June rate hike, which I am expecting, will be a spike in the economy and will get to maybe uncomfortably close to a recession, and the Fed will flip-flop back to east. Now, that's not what the Fed would say if you talk to the Fed, and Danielle's probably right that in their own minds, with bad models, they think they're on track to raise 2 or 3 more times over the course of this year. But I think 1 more in June will be enough to stall out the economy and cause them to flip to ease for the 9th time since May 2013.
That would be very interesting for them to reverse. I wonder how Wall Street would talk about their credibility then. But I think, this is all, Jim, leading to a lot worse stagflation coming in the real economy because, these central bankers, the more they intervene, it seems the more problems they create. But I want to thank you for your time today. And I really recommend reading your newest book, The Road to Ruin. I finished it last month. It was excellent. And how can our listeners buy your book if they want to do so?
Well, all my books are available on Amazon or Barnes & Noble online or at good bookstores. And, of course, The Road to Ruin is my most recent book. But actually, the paperback edition of The Death of Money has just been released. That book originally came out in 2014, but it's been hardcover for 3 years, just out now this week in paperback with new material, including never before published information on insider trading in advance of the 9/11 attacks. So I hope people who are interested are able to pick that up as well.
Excellent. Very good. Yeah, and I enjoyed that book as well. I've read all your books now, so I have to give you a lot of credit. I've enjoyed them. They're excellent reads.
Thank you.
Mo and I are trying to raise $1,000 per month for our Patreon account. We have over 2,600 viewers per YouTube video, so if we can get most of our loyal listeners or all of our loyal listeners to donate $1 per month or up to $5 per month, which would be amazing, that would cover most, if not all, of the money that we need. So we also accept one-time donations. If you go to the wallstreetformainstreet.com website, we accept donations in cash via PayPal. Fiat, you can donate there. You can donate Bitcoin through our Bitcoin wallet there on the website, or you can donate gold and silver. We have a gold money account, and we also accept mailed donations of physical gold and silver. Thank you guys for listening, and we appreciate any and all help. Please forward it to friends. Okay, bye.